We are discussing the National Senior Certificate of November 2014, question number 4, which relates to the cash flow statement. We are provided with information relating to Meteor Supermarkets Limited, a public company. The financial year end is 28 Feb 2014. For 4.1, it's required that we refer to information E, where we have to calculate the missing amounts indicated by A, B and C in the fixed or tangible asset note for the year ended 28 February 2014 for 12 marks. So let's refer to information E. So we have the fixed tangible assets note, we have land and buildings as well as vehicles. And if we study land and buildings, we see have the costs at the beginning of the year. We have additions of costs, number A, which we have to calculate, that's what's required. And then we have the costs at the end of the financial year. We know the costs at the beginning of the financial year plus additions in the absence of any disposals will equal to the costs at the end of the financial year. So to put it in a different way, the difference between the costs at the end of the financial year, the costs at the beginning of the financial year, will give us the solution to number A. So we have 6,740,000. So we have 6,740,000, and from that we need to subtract the amount at the beginning of the financial year, 2,689,000. So that's our calculation. So let's just see how much it amounts to. So it's 2,015,000. Okay, I think I have 102 missing here because it can't be a negative value. Okay. For number B, we have to determine disposals at carrying value for vehicles. If we go to the additional information, we will see for point 1 that a vehicle was sold for cash at its carrying value on the 31st of May 2013. The following extract of the vehicle sold taken the fixed asset register. The cost price of the vehicle sold is 100,000. The accumulated depreciation at the end of the previous financial year was 28,000, and then we still wrote off 5,600 rands worth of depreciation up to the date of disposal, which is 31 May 2013, for a total accumulated depreciation of 33,600 up to the date of disposal. Now we know that to determine the carrying value we have to subtract the accumulated depreciation of 33,600 from the cost price of 140,000. So we have to subtract from the 140,000 the 33,600. So from 140,000 we have to subtract 33,600. So it's the cost minus the accumulated depreciation. which gives us 106,000 rand and 106,400 rand. For number C, we need to calculate the depreciation for the year on vehicles. Now, we already know we have written down 5,600 depreciation on the vehicle that we dispose. So we have a 5,600 rand on that vehicle. Now we also will have to focus on the vehicles that we kept for the whole year and did not dispose of. Okay, so we will therefore have to reduce the cost price that we have at the beginning of the year of those vehicles with the cost price of the vehicle that we got rid of. So we had 3,250,000 at the beginning of the year. Let's exclude the 140,000. So we had 3,250,000. We have to exclude the 140,000. Okay, so I'm just going to put that in brackets. That's the cost price portion. But we know we are using the diminished balancing method, so we still have to subtract the accumulated depreciation for the vehicles that we had for the whole year. So we again, for the accumulated depreciation portion, we'll have to exclude the accumulated depreciation of the vehicle that we got rid of. So the 28,000, that was the amount at the end of the previous financial year for the vehicle we sold during the year. We have to exclude that from the 1,370,000. So we subtract the 28,000 from the 1,370,000. So it's 1,370,000 minus the 28,000. So we now subtracted the accumulated depreciation. So we therefore have the carrying value of the vehicles we kept for the whole year. We still have to calculate 20% on that. And then finally, we have to go back to our note and notice we had additions also of 350,000 at costs. Let's see if our additional information indicate when we purchased those vehicles. And indeed, point 2, a new vehicle costing 350,000 was purchased and paid for by check on 1 January 2014. So at that stage, we don't have any accumulated depreciation. We are going to write down depreciation for the first time, only for the month of January and February. So it's 2/12. So for the new vehicle, we will have on 350,000, a 20% for 2 of the 12 months. So multiply by 2, divide by 12, and it's also at 20%. And then we get the total depreciation of 370,200 rand. Let's just indicate our calculation in detail. (4.2) Complete the cash flow statement for the year ended 28 February 2014. Some of the details and figures have been entered in the answer book. Show workings in brackets. So if we go to the answer book for the cash flow statement, we see that cash generated from operations has already been supplied. The interest paid has already been supplied. If we know our structure, we know the next item is the dividends paid. And we also know that for dividends paid, we start with the amount reflected in the financial statements, usually from the retained income note. Let's see what is given to us in this particular question. So we have an extract from the income statement, we have an extract from the balance sheet statement, we have the shareholders register. We have dividends for the financial year ended 28 Feb 2014, the interim dividends paid on 31 August of 750,000, as well as the final dividends declared at the end of the financial year of 870,000. We know usually these appear in the retained income note. We add them up, and we also know that our assumption is we start with a outflow. So we have negative 750,000, negative 870,000. Next we need to look at the opening balance at the end of the previous financial year that we find in our balance sheet, or the notes to the balance sheet. In this particular case, you can look at the extract from the balance sheet. And current liabilities, we have shareholders for dividends. So the previous financial year, at the end we owed 480,000. We will thus pay during this financial year. That will thus result in an outflow of cash. So it's a negative 480,000. And then we owe at the end of this financial year, so it won't flow out this financial year, it will be an outflow next financial year. So for this financial year we show it as an inflow, and that inflow is 870,000 rand. So all that remains is to do the calculation. So we have negative 750,000, negative 870,000, negative 480,000, plus 870,000, which results in an outflow of 1,230,000. The next portion, if we know the structure of our cash flow statement, is the taxation paid. And if we can manage dividends paid, we know how to do the taxation paid. The same principles apply. We start with the amount reflected in the financial statements, in particular the income statement. So let's go and find the income statement extract. We have the income tax of 441,000 rand. Starts as an outflow. So we have a negative 441,000 rand. Then we need to go and look at the situation at the end of the previous financial year as indicated in the balance sheet. In other words, did we owe SARS or did SARS owe us? So let's find the extract from the balance sheet. SARS income tax, previous financial year. We see we in fact owed at the end of the previous financial year. That means we will actually pay this amount during this financial year, which will result in an outflow. So it's a further negative 120,000 rand. And now we look at the situation at the end of this financial year. So if we go back to the extract of the balance sheet, at the end of this financial year though, SARS basically owes us. Okay, so usually if we owed SARS at the end of the financial year, it will work like dividends. We will add back the amount, but now it's the opposite situation. SARS owe us, so we will have to subtract a further 128,000 rand. And all that now remains is to do the calculation. So we have negative 441,000 rand, negative 122,000 rand, negative 128,000 rand, for a total outflow of 691,000 rand. Next we have the cash flow from investing activities. And we know from the first part that we actually did purchase asset during the year, which will result in an outflow of cash. So therefore we have purchase of assets. So let's go and consult that fixed tangible assets note again. So we did calculate already that our additions at cost for land and buildings in A. So we can take the ons of A, we can add the 330,000 worth of vehicles that we purchased, and we know all of this will result in an outflow of cash. So we have the 4,051,000 4,051,000, and then we still have the 330,000 rand as reflected for vehicles. So that gives us an outflow of 4,051,000 plus 330,000. Investment side, we also have proceeds of fixed assets that we disposed of. So that's part of our investing activities. Which will result in an inflow. And if you can remember, we actually completed as part of 4.1 number B, we determined the assets that were disposed of at carrying value. It was a vehicle that was disposed of. It was the 140,000 minus the 33,600, and it was for number B, disposals at carrying value. So we can find that value from 4.1, so it's 106,400, and when we sell something we will receive money, so it's an inflow. Next we are focusing on the cash flow from financing activities. So point number C indicates the data regarding shares. We know one of the ways to obtain financing is to issue shares. Other way is to take on loans, and then we can also share buybacks. That is when we buy back the company shares, which is basically the opposite of issuing new shares. So let's first focus on the shareholders register. So 1 March 2013 we had 1.2 million shares in issue, and then on 31 March 2013 300 shares were issued at 8 Rand each. So we will receive the 300,000 times 8 Rand, so that's a cash inflow. So we have proceeds from issuing shares, and as indicated, it is the 300,000 Rand, or the 300,000 shares rather, times 8 Rand. So that should give us an inflow of 300,000 Rand times 8 of 2,400,000 Rand. On 31 December 2013, the company bought back 50,000 shares from a dissatisfied shareholder, S. Smith, at 9 Rand 50 each. The average price of all shares issued to date was 6 Rands per share. But we are interested in the outflow of money when the share buyback takes place, so it will be the 9 Rand 50. So it's 50,000 shares times 9 Rand 50. So we have the share buyback, and it's the 50,000 times 9 Rand 50. And that will be an outflow, so we need to insert the brackets. Finally, in terms of financing activities, we need to be on the lookout for loans, and we do have a loan that is shown in the extract from the balance sheet, namely the mortgage loan with XL Bank. 28 Feb 2013 it was 508,000, and now 28 Feb 2014 it's 908,000. So our loan increased, so we obtained more money, which would result in a cash inflow of 400,000 Rand. So we have a change in loan, and it's the 908,000 minus the 508,000, and that would be an inflow of 400,000 Rand. So now we're at the point where we can actually get the totals for all of the sections of our cash flow statement. So we can find cash flow from operating activities. It is simply adding up or of the current amounts that we have, the cash generated from operations, the interest paid, the dividends paid, the tax and the taxation paid. So if we simply add up all of that, we have a outflow. We do the same for cash flow from investing activities. So we simply add the purchase of fixed assets and proceeds from fixed assets disposed. So that's another outflow. And then finally we have the cash flow from investing activities. So we add the proceeds from issuing shares with the share buyback and the change in loan. In this case we have an inflow, and now we can get the net change in cash and cash equivalents. That's simply adding up the three different sections, namely the cash flow from operating activities together with the cash flow from investing activities, and finally the cash flow from financing activities. So in this case it was quite a huge outflow. We had a cash and cash equivalents of the beginning of the year. If we add those two, we should get the cash and cash equivalents at the end of the year. So we have the net change in cash and cash equivalents. We add the cash and cash equivalents at the beginning of the year, and we end up with a 501,500 then red cash and cash equivalents at the end of the year. We can go and verify this 501,500 basically overdraft that we have. Let's just go to the extract from the balance sheet. As we can see, we have a bank overdraft of 515,000, and then we have cash and cash equivalents of 13,500. So if we calculate the difference between those two, we have 515,000, and from that we subtract the 13,500, and then we get again to the 501,500.